In today's video, we'll be talking about a new word we learned from the most recent FOMC, a hawkish pause. Today, we'll be talking about economic data and then the FOMC. Then we'll talk about whether the Fed has a hawkish narrative or a dovish narrative and what are some kind of factors that are supporting either narrative. Then we'll talk about how the US draw liquidity from the rest of the world. Then we'll talk about the US dollar index and also the bond yield. Then we'll talk about equity market and with what's happening with the AI mania. And then finally, we'll cover off with commodities. Now, once again, I'm not a professional investment advisor. Please conduct your own research. These are only my personal opinions. First up, taking a look at the most recent economic data in FOMC. So with the jobs data, it continues to confirm that employment has peaked, where we see unemployment rate increases. We're also seeing from the initial claims weekly report that we're seeing, initial claims continue to increase and unemployment rate is increasing. So what we're seeing is another thing is the hours worked are decreasing, so that means, again, we're not seeing the kind of tight jobs market that is continuously being hung on to by the Fed. And so we're seeing weakness there. So finally, it's being caught up because we talked about this before, where we're seeing a lot of the tech companies are laying off employees, but we're not seeing that being reflected in the jobs report just yet. And now we're seeing that finally filter through. And with that, that's potentially what's sparking the Fed's cautiousness on a continuous rate hike, but we'll talk about that later. Next up, let's take a look at the CPI data. So it's showing slowing of increase. Again, we're increasing at decreasing rate, but we haven't found a negative print yet, meaning we're not seeing prices falling, but they're just increasing at a decreasing rate. And what I'm thinking we should focus on is the month-over-month figure, because that's where we'll be able to gauge, is inflation getting to the Fed's 2% target. So we're seeing if the month-over-month figure, if it's getting to 0.2%, if you annualize it, times by 12, or if you really want, multiply by each month by month, you'll approach, the 2.4, which is approaching the Fed's 2% target. At which point, I think that's when the Fed will really look to say, like, hey, we've done enough, like this is where we're getting to our 2%. Like, that's when they'll maybe move their mind away from controlling inflation. But in my opinion, I am doubtful of more downwards pressure coming from things like secondhand cars, energy, while something like medical could likely pick up. Again, we talked about this before. Medical costs have been a downward driver because it's the calculation is based on medical insurance, in terms of the fees collected, but the medical costs didn't increase because a lot of people didn't go see doctors during the pandemic. But now that pretty much the pandemic's over, will more people go to see more doctors, making up for all the checkup appointments that they have missed, over the past few years? Like, would that drive medical costs back up? Taking a look at FOMC, we did see the rate pause for June, and it's hinting on a ongoing rate hikes, maybe one in July and maybe another one later on. But that's something to continue to see. Now let's take a look at what are some factors that would support a Fed hawkish narrative. Taking a look at the dot plot, this is where FOMC voting members are able to kind of put down what they think the terminal Fed rate is for this year, for the next 3 years. And what we're seeing is that when we average it out, that should be what we think the terminal, like the final Fed funds rate would be by a certain time. And we're seeing that the rate for this year, we're looking at one or two rate hikes. It's right in between, um, so right between 25 to 50 uh, basis point hike. So meaning that we're hinting that rate hikes are not done. There's at least one or two more to go. And when we take a look at a longer horizon, meaning, you know, 2024, 2025, we're seeing, rates are not coming down as fast as what, the market is anticipating, where they anticipate, one or two rate cuts this year. It's hinting that there won't be rate cuts until 2024. And another thing is taking a look at the trend of the rate hike. We have, 25 basis, 50, 70, 75, 75, and we have three 25s, and now we're pausing. And one could argue that the Fed is pausing in this meeting because there's no half of a 25 basis point hike. Therefore, it's hiding one 25 basis point hike every two meetings. Now let's take a look at the dovish narrative. So, for example, Fed is behind once again. So the Fed was late hiking rates in 2021, and also not fast enough in 2022, and they didn't get ahead of the inflation leg. So, for example, you print a lot of money, you lower interest rates, inflation doesn't show up right away. It works through the system. It comes at a leg. The first sign they see it, they should have done something, but they were late, maybe because Powell was trying to get renomination, whatever. And now what we're seeing is as economies, or again, it's already slowing down. We can look at the PMIs, we can look at consumer confidence. Obviously, that's not the best indicator, but it's one. Even it's showing up in indicators like unemployment. So now pretty much it formed, and with an inverted yield curve, it's showing the full picture. And commodities deflation is has already shown up. Like we saw commodities already falling so much over the past half a year. And so once again, the Fed is behind again. So that means it's looking in the rearview mirror. It's not looking ahead. And if it continues to do so, it will be behind again and cause, more issues like maybe more bank failures or other liquidity issues. And what is potentially happening right now is the Fed is actually seeing the weakness in labor market, and maybe that's why they're pausing uh, in this meeting. And it's Fed instead of Federal Open Market Committee, it is possible that they're doing open mouth operation where in the last meeting they hiked rates, but then they came out with dovish narrative. This time they paused rates, but then he came out with a hawkish narrative. So what he's trying to do potentially is, you know, they're doing one thing, but to avoid any overreaction from the market, what they're doing is to counteract what they're doing with narrative. And I think, in my opinion, is more important to focus on what they're doing instead of what they're saying. And so what we're seeing is, yes, there's a rate pause in this meeting. Will there be another rate pause in July? Is there going to be any liquidity issues in the meantime that could push more pressure for the Fed to not hike again? Or will there be more tensions around the world, more AI mania that push up equity prices, that puts more pressure for the Fed to, continue to stay strong and, not pause anymore and hike one more, right? These are all things to consider, and I think we won't know for sure until we see in the next meeting. But then, in my opinion, we need to focus on what they're doing instead of what they're saying. Now let's talk about how does the US draw liquidity from the rest of the world. First, with the inverted yield curve. Now, this is something to note. Like this, the yield curve has been inverted for the longest period of time in history, and we're seeing with the short end borrowing costs, this is for foreigners if they want to invest in the US, right? You're borrowing for, 2, 3, 6 months, a year to invest in the US because you're seeing like, oh my God, look how, equity market is performing amazingly because of, AI mania. So let's say you want to chase NVIDIA from, a foreign country. So, you buy you borrow US dollar in order to do that. The long end is borrowing costs for domestic borrowers to borrow from the rest of the world. So let's say companies in US who want to borrow from the rest of the world, they borrow in the long end. And so that's where we see disparity, and that is it is drawing liquidity into the US. And again, you need something to attract people to want to put money into the US, something like, the equity market bubble. AI mania, we see like seven stocks. It effectively is driving S&P to new multi-month high, where we see the rest of, the 493 S&P stocks are not doing too well. And so we're seeing the move has been extremely concentrated, and that is not something that you expect in a broad market, uh, a broad bull market. So I think this is again just a bubble. I think we're just waiting to see uh, and when does the steam run out, and we're back onto the lower end until we see the Fed really pivoting. Then I think equities market would be good to go. But until then, I would be extremely cautious with this AI rally. Now let's talk about the US dollar index and the bond market. And so for the US dollar index, we're starting to see some weakness. It's falling down to 102 on Friday. And what we're seeing is with euro and pound strengthening from the rate hikes, um, even though the US dollar is appreciating against currencies like yen and other Asia currencies, Japanese yen, like the Bank of Japan, is really just there to feed and support the Western uh, countries with, extremely cheap liquidity, you know, while hurting their domestic savers. Like honestly, if you are a Japanese citizen or people who, or anyone who hold Japanese yen, like you are getting screwed by the Bank of Japan, as Bank of Japan allow other countries and companies in other countries to borrow in yen and do whatever they want, invest or conduct business, while if Bank of Japan really cares about its citizens who does a lot of savings, you know they would have let rates go up and not print money. But that's a story for another day. Yen is effectively helping strengthen the Western currencies, and also making other Asian countries to have more incentive to devalue their currency in order to maintain their exports. Because, for example, if the yen depreciates more than, let's say, the Chinese yuan or the Korean won, it makes it so Japanese goods are more uh, attractive to foreign buyers, and therefore try to match that. We see other Asian countries devaluating their currency too, and what that does when it comes to appreciating value of Western countries, it lets it so they don't feel the effects of inflation as much because they're able to buy more uh, due to the currency exchange. Now let's take a look at the bond market. So the bond market remains more attractive in terms of risk reward, risk adjusted reward, with the S&P 4 PE being 19. So 1 divided by 19, that means they're looking at a yield of 5.2%. But the U.S. Treasury, again supposedly risk free, just ignore any default or inflation risk. Um, being risk-free from 3 months all the way to a year, they all yield above 5.2%. That means you can have the same yield without the risk of principal. So again, treasuries supposedly risk-free, yielding about the same amount as the equity market. That means even if you want to take some risk, you can go up or go down the quality ladder and take either corporate bond and generate that extra yield without taking as much risk as equity market is. And so that's why, in terms of risk adjusted return, uh, bond market remains much more attractive than the equities market in US. Now let's talk about the equity market. So again, mentioned before, the AI mania. So yes, obviously AI is taking over and will continue to when it comes to, our day-to-day life, technology, so on and so forth. But the question is at what price? So I just Googled this, Nvidia market cap is just over 1 trillion. Google was showing 1.05 trillion. And if we take Nvidia out, like the company, by itself and count as a country just with its market cap, compare that to stock market cap with, by country, it would place Nvidia on number 14. And it's above places like Hong Kong, Ireland, Brazil, and it's just below places like Taiwan, South Korea, and Netherlands. And what that means is that you're betting that one company, Nvidia, has better future. Like if you buy one share right now, today, at whatever the market price is, you are betting that Nvidia would perform better as one company than places like Hong Kong, Ireland, Brazil, and just below, some of the other countries. That is insane. That kind of reminds me to another example back in like 2000s with Yahoo having higher market cap than all of the stocks in Australia, which again that kind of puts you into think like that should put things into perspective. Like, are you really thinking that one company will generate more cash flow, have more better future? That if you do, that's what you're saying right now if you buy right now at the market price. Again, we're not talking about whether or not AI will take over. We're talking about at what price. And the current market price is saying that this one company will do better than places like Hong Kong, than Ireland as a whole, Brazil as a whole, when it comes to their stock market, their their respective stocks on their exchange. Um, And unless something breaks, unless maybe we see more banking crisis, we see maybe some corporate defaults, maybe real estate, all right, that continues to be under pressure because rates are moving up, but then defaults, more mortgage refinance, that takes time. That comes at a lag. Liquidity concerns, unemployment spike, or significant equity price drawdown. I believe the Fed has the pressure to continue keeping rates high unless one of these, like, they're pretty much keep trying. They're trying to not let something break, but also trying to maintain the course. So they're kind of, playing both sides, right? They're slowing rate hikes, but saying like, hey, we'll do it. You better not get too excited. We'll keep raising rates. You better not get too excited and, start buying everything, right? That's kind of, they're really trying to play, walking a really fine line. But, at a certain point, you know, either the market has to come down in terms of its expectation with Fed easing sooner than expected, or the Fed will actually have to, right? So one of those things will happen and we'll see. Finally, talking about commodities, right? Commodities operate in a cyclical nature. So we saw significant commodities draw down, in the recent past. And potentially we're starting to see some commodities, starting to rally, right? Looking at soybean, wheat, corn, looking at mid-May, May 15, that looks like it touched, kind of um, 2022 July low, and looks like they're starting to rally back up again. Does it have legs? We'll see. Oil continues to hold above $70. It dips below and then it rallies back up, right? Maybe that has something to do with OPEC plus. Continues cut. Maybe that has something to do with China potentially recovering, and or will the recession fear continues to draw oil down, right? That's the question. Fundamentally, I think commodities, they're looking for reasons to rally, whether OPEC plus, China recovery, but they're really waiting like for the Fed pivot confirmation. Once the Fed truly pivots, I think again commodities is where you want to be because they have just been so beaten down, and you also have the cyclical nature to support it. So you have both, you know, they have been beaten down because, due to cyclical nature and, waiting for the Fed. And once the Fed confirms the pivot, I don't know when, but when it does, I think commodities is where you want to be, not this overpriced equity market. Thanks for watching.